Hello and welcome to our keynote Fireside chat. I'd like to welcome Rick Squire, Portfolio Manager at Acorn Capital. Rick has responsibility for the provision of research and selection of holdings in the resources and energies sectors, undertaking fundamental investment research on companies within those sectors, and selecting stocks for the inclusion in client portfolios. Rick is a geologist with over 20 years of experience across the mining, exploration, and research of mineral deposits, with the past 7 years in mining finance. A warm welcome to you, Rick.
Thanks very much, Andrew.
A big theme over the last year is the Greeny Economy. How is Acorn Capital playing this investment thesis?
Yeah, we certainly recognise the transition to the global transition to the low carbon economy, and so in the energy and resources sectors, we're certainly tilting our portfolio towards those commodities that will facilitate that transition. And we can see the obvious ones in terms of those, energy storage or electric vehicle metals, but even in energy, that the recent renaissance in uranium, and how we're actually thinking about oil, gas, and coal is also influencing how we construct the portfolio.
Mm-hmm. And which battery metals are you particularly bullish about?
We like, particularly like lithium. That's had a great run. It's there's probably getting a lot of the valuations are getting stretched at the moment, but we see that lithium has been a great commodity for us over the last 12 months. Also like nickel and copper. In Australia on the ASX, it's difficult to get quality companies with direct exposure to copper. But there are some gems out there. It just takes a little bit harder to find them. Nickel's a little bit different. We actually have quite a few nickel producers, developers, and explorers. So we have a mix there. And then there are sort of the newer range of metals from the rare earths, graphite, cobalt. Cobalt's a little bit hard to get direct exposure to, but looking for that suite of metals. So we see great opportunity across a range of commodities in that energy storage or EV metal sector.
And just in terms of the companies that you invest in, is it just ASX listed companies, or is it also or is it also your preference for investing in these companies if they've got actual deposits in Australia?
No, we have our focus is very much on companies that are listed on the ASX, so they can have assets or operations that are anywhere in the world. We do have a capability to invest in other exchanges, but we use that as a niche opportunity. So an example is there aren't many quality silver projects in Australia, and if you go to the TSX, you'll notice that there's quite a lot of explorers, developers, and producers in that silver space, and that's actually a geological bias, that you get a lot of these polymetallic like lead, zinc, silver deposits or gold, silver deposits, in North, South, Central America, a bit like we have a lot of big iron ore deposits in Australia, but you don't see so many in North and Central America, South America. So there are a few unusual ones, but there's a geological bias driving that, and then that gets reflected in the different exchanges. So not all funds, but a couple of funds, we can invest up to about 10% on other exchanges. And so that's why we're always aware of what's happening, but we're looking for niche opportunities rather than another gold explorer. We've got plenty in Australia. We don't need to go to the TSX to find a gold explorer or a gold producer.
You mentioned some of the battery metals that you're excited about, lithium, nickel, and copper. I was just wondering, I guess, especially in the case of lithium, is the market quite overcrowded out there? How do you go about sort of stock selection in terms of picking out the winners from the losers?
Yeah, that's a great question, because there's we saw in the last lithium boom that back in sort of 2016, 17, that there was great money was generated by those jumping on those development projects, and a lot of them were the spodumene, the hard rock lithium mines, and there were companies like Galaxy and Pilbara and even Mineral Resources exploited it beautifully in terms of starting up new operations and really extracting value from those. And then there was the downturn and the lull, and then it's come back again. So a lot of those producers have merged, and so they've actually, when we look at them, they're big companies. They've got really good in-house expertise to develop and produce these assets, and they've even got really nice development pipelines. So when we then look down to the next level, it's actually getting a little bit trickier, because a lot of those projects are the ones that didn't get up first time, and the reason they didn't get up is because they weren't as good as the ones that got away. And so what we're now seeing is some of these lithium companies are getting into projects with deposit styles that have never been developed before. And we see that because we think very much about the technical aspects of the project. We see that as a particularly risky part of the game and the investment universe. And so these things like these lithium clays or these brines with unusual chemistry, that you notice that there were very few new brine operations getting into production, yet now they've really taken off, and people are applying these ion exchange methods and things. And while there will be some winners in there, and there's some companies that are well positioned, others it's just an enormous risk, because but people have tried with geothermal plants in the western part of the US. They've tried to modify these and use ion exchange to extract metals. Now they're talking about lithium. They've talked about precious metals and other metals from these balls, and the ability to actually generate the recoveries that these companies are forecasting is the greatest challenge. So not only have you got to have the flow rates and the metal concentrations, you've also got to have the recoveries in these things, and we don't know how that's going to go. And past performance in that field has shown that it's been very poor. Now, technology is improving, but it's really largely an unproven area. So we see it as a risky space, and that's why we're watching that area very cautiously.
Mm-hmm. You mentioned earlier rare earths. What attracts you to rare earths as an investor, and what's different from the last rare earths boom of about 10 years or so ago?
Yeah, sure. We really like rare earths. As you're probably all aware that they're used in the high strength magnets that are in wind turbines and electric vehicles. And so an example is the standard wind turbine you'll see might be 2 or 3 megawatts. Well, they'll contain 500 or 600 kilograms of rare earth oxide in each wind turbine. And these are not the massive ones that are 8 megawatts, but just the standard size. So that they require huge volumes of these rare earths. And when we talk about, when countries talk about critical minerals, they're really just talking about the rare earths and the and cobalt. Now, when it comes to the rare earths, there are actually 17 rare earth elements, but there are only 4 that are actually any value. And they're the ones that investors have got to really focus on. So they're crazy names, but they're dysprosium, praseodymium, neodymium, and terbium are the 4. And samarium, sometimes that can be an important 5th one. But there are 4 key metals that they're after. So you've got to look for the projects that have got those 4, rather than the highest grade is not so good if it's a high grade in an element that no one uses. So you've got to know which of those rare earths to go for. The second thing, which is that the market probably is slow to catch up to, is there's a geological bias. There's a geological reason why China is dominating the production today. And the main reason for that is they have these unusual deposits called ionic clays. And in those clays, there are clay particles with a film of metal ions that just sit on the outside of those clay particles. And so they can dig up the clay. It's near surface. They put on a plastic lined pad, a heap leach pad, and they can flush it with an acid, and it just desorbs, or it carries away the metal ions in solution and precipitates out. It's very easy to mine, very easy to process. Companies like Lynas got very good grades, much better grades than the Chinese, but they these days they drill and they blast. They then have to crush that material down, separate out little minerals called monazite. Some operations separate like a bastnasite. But then those minerals have to be heated up, refined to 600 or 700 degrees Celsius to extract the rare earths. The problem is when you concentrate them up, you concentrate up the rare earths, but you can concentrate up small amounts of uranium and thorium. And so that becomes the material handling and social issues about waste disposal on those products. So you might have a project that appears to be higher grade, but if the mining costs are higher, the processing costs are higher, you have material handling and waste disposal issues, well, they're probably not the ideal project. You're probably better, like in the case of the Chinese, mining these lower grade deposits that have very simple processing and mining, and they don't have those deleterious elements. So we think that's really important in terms of the decision making, in terms of where you invest, and we think the market will start to pick up on that point soon.
Are there enough are there enough rare earth mining companies opportunities outside of China? Because it doesn't seem to be that there are that many rare earth mining companies at the moment, or certainly not as many as the last mining boom.
Yeah, true. There aren't many, so it is a crowded space. But you can now start to differentiate between them. And we've seen recently some of the challenges, such as in Greenland, with the social issues that are coming up. That there are a few players, and the ability of those players to actually get into production, in a reasonable time frame is challenged. So you're right. There are only a few, but I think as people start, it's one of these things that we didn't think there were many spodumene deposits until a few years ago. People started then looking for them, and they start to find more and more. So there's always a possibility that people will start looking for these deposits and find them in places where they were previously not recognised. And so that's what the job of investors like myself is, just to be scouring the literature and scouring the news feed and looking for those opportunities and talking to people, because they will pop up quickly. And there's every chance that there could be a big success. So an example from the lithium boom is Kidman Resources, that they had a gold project, and then they just assayed a bit of core that had been sitting in a drill core in the core shed for probably 15 or 20 years. They went and analysed it, and they discovered one of the great spodumene deposits.
What other commodities outside of the battery and rare earth metals space are you attracted to at the moment? Yeah,
we really like that. Really like that battery space, but we're still seeing really good value in gold. Gold had its big boom and a big run last year, but from about September we've seen quite a pullback, and now they've stabilised. You can actually start to see, particularly among the producers, where the companies generating plenty of cash, they've got no debt, and in a really good position, and a really nice pipeline in terms of their revenue or free cash generating potential is really strong. So we see some really good opportunities. Now in Australia, there's a little bit of a minefield out there, because we're a bit slower compared to the rest of the world in terms of coming out of the COVID lockdown. So I'm still in a lockdown here in Melbourne at the moment. Perth's going well, but it's not to say that there might be some challenges over the next few months as we transition to this new sort of COVID normal world, that it could impact production and therefore create volatility in the space. So we really like gold for that reason. Outside of resources, we still like oil and domestic gas. We think there's a great opportunity there. As we come out of lockdown, people start travelling more, whether it's in airlines or just down to the beach for a holiday. That there's going to be a pickup in consumption, and there's been a real focus on demand destruction, but not many people have been thinking so much about the supply destruction that's coincident with that. That the rebound will be quick, and supply we won't be able to come on as quickly as in the past.
Well, we're certainly seeing some supply chain challenges with our gas supply here in the UK at the moment,
Yes.
as you've sort of probably seen in the news. In one of your early answers, you talked about uranium. I have to admit, I'm quite cynical about uranium because I joined Mines of Money in 2014. Every year, a load of investors and analysts say this is going to be the year of uranium, and it never ever quite happens. Am I right to be cynical? Or if I'm wrong, can you just tell me why I'm wrong?
Look, I carry a high degree of cynicism too. We've done quite well in this recent run. We saw it ran hard. To look at the stock valuations, and they were quite crazy. And even when I look at the spot price today, around $50 or thereabouts US, that a lot of these operations actually need something in excess of that to actually operate, and they're not going to turn it on and only make a little bit of money. And the other thing is there are a lot of mothballed operations out there. So whether it's Cameco with MacArthur River and the potential to expand existing operations, the same for the Kazakhs that they've curtailed operation. They could easily lift production from. They've pulled it back to 80%. They could let the throttle out, and then they could actually expand it beyond what the existing capacity is. So there's a lot of room to move there. And so these companies that have got development projects that are long dated, I think they're more challenging. They've had great leverage running into this recent bull run. You can see plenty of money being made there, but we're seeing a lot of that unwind at the moment. So it'll be certainly volatile, but that volatility creates the opportunity. So if you get in, but you also know when to hop off, that creates opportunity. So that's how we're seeing the uranium space. It's an opportunity, but I don't think it's going to the moon just yet.
You mentioned in a few of your answers, you've touched on technology and the role of technology in mining. I'm just curious, do Acorn invest in mining technology companies?
Yeah, so I look after the resources and energy portfolio for Acorn, but we as a company, we're a generalist fund, and we do look at these technologies, and we invest in listed and unlisted companies. In fact, a major part of what we do is unlisted companies. So we are looking for those opportunities. So we don't have anything in the portfolio at the moment, but it's something we regularly screen, and we've seen a number of them, from new seismic technologies to assaying technologies. So it's something that we follow very closely, and we've been very close to getting across the line on a few of them, but not recently.
Mm. When you're making an investment, how important is ESG to Acorn Capital?
Yeah, it's really important. We've been thinking about this for quite some time. So an example of that is that since mid last year, or sort of early to mid last year, we made a strategic decision that we don't invest in thermal coal anymore, and we do invest in coking coal. We think coking coal is important. You need high strength steel to build a wind turbine, and so some of those coking coal producers will produce a small amount of thermal coal. So we do have a threshold of up to 20% revenue from thermal coal, but it's mainly because they all produce a small amount, so we've just got to accept that a small amount will be produced. And when we think about oil and gas, we think about think about in terms of what's the carbon footprint per barrel of oil produced. So what we're looking for is the producers with that, at least in scope 1 and 2, the lower carbon footprints, and so whether that's avoiding those with a sort of high CO2 a byproduct associated with it that gets flared, or whether it's just really an energy intensive method for extracting each barrel of oil. So we think about those sorts of things, and we think eventually the market will recognise that there is a difference between the barrels of oil that are produced in terms of that carbon footprint. So that's like on the environmental side. The social side, I was mentioning, the rare earths and the importance of, waste disposal in terms of, uranium and thorium content associated with the rare earths. And governance is a really important thing. And we spend a lot of time talking to, in particular, the smaller companies that we invest in, what what we expect them in terms of, a governance requirement, in terms of voting, in terms of the board diversity, all those sorts of things. So it's something, we take seriously, and we've been thinking about for several years now.
Is there any sort of like differences at the exploration end as opposed to the production end of the mining industry? I guess the question behind the question is, when I talk to producers, they seem to have been thinking about ESG for a number of years, but at the exploration end, I think they're only just slowly like coming around to it. So I'm just kind of curious, what sort of differences you're sort of seeing, and are you seeing it change at the exploration ends?
It's interesting. I actually think a lot of the explorers that I deal with have been thinking about ESG all the time, but they haven't actively promoted it or mentioned it. So an example of that is, if you're an explorer and you're working, even if it's in West Africa, you have to go in and get a social license to operate there. So they go in, and you go back and look at any presentation for the last 10 or 15 years. They talk about the social programs that they've got in terms of, how they interact with the community, and it's not just, we employ people, that should be good enough. That they support local schools and hospitals and whatever it might be. So, and it's not just the central government in the capital city, but it's all the small villages around them. So they've been thinking about that really social side, and obviously the environmental side is important too, in terms of rehabilitating the site and leaving it in the way that it was when they first came through. And again, that's an environmental and social side. And then governance. The governance, if anything, that's the area it's been a bit trickier. And now partly that's because you have a small board, you don't have all the experience that you need. If you're a gold explorer, you want to have a really strong technical board with someone providing the oversight on accounts, and so you really don't have that diversity. And so that's why we get in and we give them some support, because if they are to be successful, they've got to transition very quickly from explorer through to producer, and so they've got to have all those systems put in place. So they've got to be thinking about it, and so, okay, well, I better do it now, because if I want to get to that point, I'm going to have to do it anyway. It's easier if I start now rather than try to pick everything up at the end.
Mm-hmm. And just one sort of like last question, just to go and wrap up. Have you made investment decisions over the last 18 months not being able to travel, or it's been hard to travel from Australia, or like meeting mining teams face to face and doing mine visits? Because usually when I talk to investors, they say I don't invest unless I've met the team face to face, or unless I've done a mine visit.
Yeah, that's right. That's just something we've had to accept and had to get used to. Zoom meetings, but we were using Zoom for years before COVID, and we were doing that with the geologists and the mining engineers, on site. So prior to COVID, we'd done Zoom meetings with company representatives, like the engineers and the metallurgists, and they were in Peru, in Sweden, in Canada, in the US, and all around Australia. So the way we've done it is we will always talk to the company, we get excited about an opportunity, and then we do a video link up where we talk to the geologist or the mining engineer on site to wander through some sections, go through the mine plan, understand the detail, so that once we do land on site, we're actually, we hit the ground running. We know where we want to go to look. We say, okay, we want to go and have a look at this pit that's got the failure, or we want to go and have a look at this new drill hole in this area that you're really excited about, so we can get a feel what it looks like. So a lot of that's the core of it. So yeah, it is difficult that we've haven't been able to visit the sites, but then we're not being disadvantaged any more than others. That we've still got out. When there were little windows, we were quick to travel. So I've done it only within Australia, but I have done interstate trips over the last well, the last 9 months to get out to do a couple of site visits. Obviously, love to have done a lot more, but hopefully that's going to start again. But between myself and my colleague Karina Bader, we've got a lot of that experience that we've been to a lot of these sites that we can sort of smooth over the cracks with our past experience. But as soon as the lockdown's lifted, we'll both be out there looking at as many opportunities as we can.
We certainly hope that the lockdown is lifted soon there, and we hope to see you travelling again soon. But I think we're out of time, so thank you very much. That was Rick Squire, Portfolio Manager at Acorn Capital. Thank you.
Pleasure. Thank you.